Hi everyone, I'm going to talk about contracts today. I'm going to explain contracts a little bit, and I'm going to talk about Apple because this is my favorite stock to buy, and the options they give are really good. If you want to buy options, you write the stock you want to buy option for, and here in this example I'm buying for Apple. So you write this Apple, then you go to trade Apple option. Okay, the most important thing is the expiring date. The break-even price and to break-even percentage and the price. The expiring date, I always prefer to choose 2023 date to be on the safe side. Like we have 2 years from today. And I always prefer to choose a price that close to today's price, which is 135. If you notice, the price goes up the more we go down, because the more we go down, to break even percentage goes down. That means like in June 16, 23, we are expecting the price to be 136. If you notice today the price is 135, and after 2 years we expecting the price will be 136.6, which means the price goes up by 1.26%. Okay, so if we want to buy this today, we're gonna pay 76.68 per share. If you go to continue, you're gonna buy a contract, but you have to remember always that a contract contains 100 shares. So once we write once we buy a contract, means that we are buying 100 shares. So here the 76.68 times 100 is 7,670. I don't want to buy this contract because this contract is a bit expensive for me, and I would say I would choose this contract to break even percentage is 2.57, and this contract would cost me 6,345. Okay, see the big difference between this and this is almost 0.75%. Okay, this is fair enough. So if you buy this contract today, you're gonna pay 6,345 today, and the rest you're gonna pay it when the expiring June, when the expiring date is, which is June 16. But what we're gonna do is we're not gonna wait till the expiring date so we can buy or pay the rest of the 100 shares. We're gonna sell the contract before the expiring date for a profit. And if you notice that we're not we're still having 100 shares, but we paid less, way less than what already 100 shares cost. But you have to keep in mind that if you want to buy a contract, don't buy it when the stock price is high. If we go through back in 3 months, you will notice that there's always a spike and dip, spike and dip, spike, dip. So what you need to do here is you buy a contract when there's a dip, and you wait till you make a profit, let's say a 500 per share, and you sell the contract you have. And you wait till there's another dip, and again you buy a share, you buy a contract, and you wait till there's a spike and you sell it. Let's say you didn't sell at this spike, it's alright, don't worry about it. You wait. If you see there's another dip, you buy another option, another contract, and you keep waiting till you make your $500, then you sell. Then again you wait till there's a dip, you buy, and then when there's a spike you sell, and you wait till there's a dip and you buy again, and so on. Please don't buy a contract when the price is high. Don't buy a contract when there's a spike, because there's always dips, and always remember to buy contracts when there's a dip. Thank you for watching.